The massive U.S. twin deficits are once again raising questions about the outlook for the U.S. dollar. What is the real reason for the dramatic deterioration of the U.S. current account deficit since the pandemic? Can Trump's trade war cure the twin deficits? Is the U.S. dollar still a safe haven? What should you be doing with your money right now? Trump got a lot of flack last week when he said that the good parts of the U.S. economy are the Trump economy and that the bad parts are the Biden economy. However you might feel about Trump's trade war, there's no denying that he inherited an economy with huge imbalances. The federal budget deficit hit 6.9% of GDP last year, the highest ever recorded outside a recession. At the same time, the U.S. current account deficit reached 3.9% of GDP, worse since the pandemic days. Twin deficits of the magnitude that Biden passed on to Trump are not the norm. In fact, we have to go back to the mid-1980s to find a historical parallel. Cause and effect. The result of the twin deficits in the mid-1980s under Ronald Reagan was the Plaza Accord that brought a coordinated depreciation of the U.S. dollar. The result of Biden's twin deficits is Trump's trade war. Both tariffs and currency devaluation tilt relative prices in favor of domestically produced goods and services. The Plaza Accord helped reduce the U.S. trade deficit with Europe, if not with Japan. Tariffs have the additional benefit of raising revenue for the government. Will Trump's trade war cure America's twin deficits? The U.S. current account deficit is the largest among major advanced and developing countries. A large deficit is less of a concern than the persistence of the large deficit. To finance the perennial current account deficit, U.S. liabilities to foreigners have been growing steadily over the past 3 decades. These liabilities have now reached $62 trillion at the end of last year. $62 trillion is $26 trillion more than foreign assets owned by Americans, and more than twice the U.S. annual GDP. There's a growing consensus in the currency market that foreigners might have accumulated more U.S. assets than they would like, and that the dollar's day of reckoning is not too far off. Before I tell you what I think, let's ask ourselves why the U.S. current account deficit is so high. There are many drivers of the current account, and exchange rate is only one of them. As you know, the current account is just the difference between national saving and national investment. Demographics should affect the current account by influencing saving or investment or both. People save to finance their retirement. Theory says the current account should worsen as the population ages, and that the likes of Japan and Italy with rapidly aging population should be running current account deficit. But the fact is that these countries are still running sizable current account surpluses. The share of population over 65 is lower in the US compared to other advanced economies. Yet, the US is one of only few advanced economies running current account deficit. And this cannot be explained away by the impact of aging on investment. For example, Japan invests 25% of its GDP even though it has a shrinking labor force, compared to just 20% in the US. Another driver of the saving rate is uncertainty about the future. Precautionary savings should have a big impact on the current account. The relatively large current account surpluses of Germany and China right now are consistent with the fact that their labor markets are less strong than the likes of Italy and Brazil. The US labor market is strong, but not nearly strong enough to explain why the US current account deficit is so big relative to those of other countries. Of course, the current account is also a function of the difference between exports and imports. What this means is that the current account of any country should have a positive correlation with the growth differential between the world and that country. The stronger is world economic growth, the greater would be the exports of that country to the world. The U.S. current account balance has over the years exhibited a positive correlation with the growth differential between the world and the U.S. However, at the current level of the growth differential, the U.S. current account deficit should be closer to 3% rather than 4% or even lower. The U.S. current account has seen a dramatic deterioration since the pandemic. How do we explain it? I think the answer is an increase in the perceived rate of returns on savings. The U.S. stock market has returned an average of 16% a year since 2020. In 4 out of the last 5 years, it's produced 20% plus returns. The U.S. stock market has done so well that equity holdings now account for 40% of the financial assets of U.S. households, a record high. Moreover, the U.S. stock market has been by far the best performing stock market in the world over the last 5 years. This outperformance has been driven by a combination of strong productivity growth and the disappearance of equity risk premium. We can debate whether the U.S. stock market is a bubble or not. But as Americans come to view double-digit equity returns as the new normal, the household saving rate has fallen to just 4%, from 7% before the pandemic. In this respect, I think the strong U.S. equity performance has been a key driver, if not the main driver, of the deterioration of the U.S. current account deficit over the past 5 years. If the outperformance of the U.S. stock market pushed the U.S. current account deeper into red, it's helped window dress the U.S. budget deficit by boosting capital gains tax receipts. It's a scary thought that if it weren't for these capital gains tax receipts, the U.S. budget deficit would be even higher. The outperformance of the U.S. stock market has had another important balance sheet effect. Over the past 5 years, the value of foreign holdings of U.S. stocks has gone up much more than the value of American holdings of foreign stocks. In 2024 alone, the value of foreign holdings of U.S. stocks increased by more than $3 trillion, versus the increase of only $1 trillion in the value of U.S. holdings of foreign stocks. We can safely say that the outperformance of the U.S. stock market has been the biggest driver of the deterioration of the U.S. net international investment position over the past 5 years. It is an understatement to say that Trump's policies look and feel chaotic. But what is very clear from Trump's policy choices so far is that not only he understands the danger that the twin deficits pose, but that he's trying to stay in front of them. Trump's trade war could be viewed as an attempt to shrink the twin deficits. All else being equal, tariffs should help reduce both the current account deficit and the budget deficit. Trump seems genuinely committed to rein in the runaway budget deficit. Doge has gone quiet since Elon Musk decided to step back, but last week Trump proposed a $163 billion cut to the federal budget next year. You may not agree with what he wants to cut, but at least he's cutting. I can't remember another US president since George H.W. Bush who agreed voluntarily to tighten fiscal policy. I think Trump is right in his analysis that the twin deficits have to be brought under control as soon as possible. But he has chosen a very risky path to dealing with them. Last week I discussed how Trump's trade war with China could backfire. I also think Trump and his team have overestimated the leverage that they have over the European Union, Canada, and even Japan. The meaningless deal with the UK this week only demonstrates just how high the bar will be with other countries. I'm not yet ready to pronounce that Trump's cure is worse than the disease, but it is definitely a gamble. The biggest risk that I see is a prolonged trade war that triggers a sharp decline in the US stock market, pushing the US economy into a recession. If this happens, we will see the US budget balance worsen more than the current account balance improves. This would increase the risk premium that foreign investors require for holding US assets, including the US dollar. A sharp tightening of financial conditions will force the Federal Reserve to come to the economy's rescue. This would be a slippery slope, of course, as monetary policy becomes just another tool of fiscal policy. What probability would I assign to this scenario? I don't know, 40%? The only reason why I'm not giving it more than a 50% chance is because Trump's ability to change course. That said, we need to see more economic pain for him to justify a pivot. This is why I remain bearish on the US stock market. Thank you for listening.